Buying a house can be financially challenging, but it may not cost as much as you think. Let me share some of the different costs and when you'll have to pay. Now, buying a house has a few different steps, and within those steps come different fees. Some have to be paid at the time you're using them, and others can be wrapped into what are commonly called closing costs. Closing costs can include things like fees that your lender and the title company charge, property taxes for that calendar year, and insurance premiums. Now, some of these can be negotiated to be paid by the seller, but some of the fees are still up to you as a buyer. So what does this stuff actually cost? The first money you'll likely have to have available when buying a house is your earnest money or escrow money. In the St. Louis market, it's typical to see a seller request a 1% earnest money amount. In some cases, a seller may ask for more, or your agent may recommend to offer more to stand out among the competition. Although this is a request of the seller, there's technically no designated amount. Technically, you could put $5 down and you've got a legally binding contract. However, that may not be your best tactic. The earnest money gets deposited by the title company, but they hold on to it in your name until closing. Now, this money is basically your promise to do your due diligence to complete the sale. Now, that's not to say that you'll never get it back. There are several ways that your agent can coach you through how to get that money back should something go wrong along the way. As long as you get to closing, this amount should come back to you as a credit at closing. So, however much you were charged for and the seller isn't paying, this amount would go toward your cash to close, or the amount that you have to bring to the closing table. The second check you'll have to write is for the home inspection. Now, this is a crucial step for you as a future homeowner. The results of this inspection will let you know what's going on inside the house, things that you and your agent just couldn't see when you first toured the house. The inspectors are performing a job for you, and they will likely be expecting to be paid at the time of service. Now, depending on which inspections you opt to have done, this number could be anywhere from $300 to $1,500. Now, that may seem like a lot of money up front, but the results of these inspections may save you thousands of dollars down the road due to some significant issues that you weren't aware of when you bought the house. Your agent can use these findings in the report to negotiate with the sellers for them to make some repairs. Next up is the appraisal fee. Now, this could be considered part of your closing costs, but better be prepared than caught off guard. The appraisal is ordered by your lender to ensure that you aren't overpaying for the house. Now, your agent likely counseled you on current market values in the area, and they made a recommendation based on their research for the best sales price. However, in a highly competitive seller's market, offers tend to go higher than the predicted market values. So the appraisers have better tools and data to determine to the single-digit dollar exactly how much a home is worth. They'll provide a line-by-line comparison of your future home to homes in the immediate area and show you how they arrived at a very specific value number. If the appraisal report comes back and the value is higher than the amount you and the sellers agreed to, awesome! You just got free equity. But if the report comes back lower than the amount agreed to, the agents have to go back to work to renegotiate the sales price. And this is because your lender's only going to be able to loan you the lesser of these two numbers, either the sales price or the appraisal price. Whichever is lower is the number they can loan. And that's why this appraisal report is so important. Now, because you're paying another professional to do their job, you'll have to pay them too. Their reports generally run between $350 and $450, so check with your lender and see when that has to be paid. Now comes the big number that you'll have to come bring on closing day. Now, most people think that in order to buy a house, one must have 20% of the purchase price saved up for a down payment. Wrong-o! Current loan options have anywhere from 10% down to 3.5%. And you may even qualify for down payment assistance programs that gift you the down payment. If you're a current or past military member, you likely qualify for a VA loan that requires 0% down. Different loan programs have different requirements, so find a loan officer that can coach you through and explain the differences and benefits of each program to help you find the best one for your situation. Loan programs aren't a one-size-fits-all, so ask questions to find the best fit. Lenders can often help you get creative when deciding which program is best for you. One option many first-time home buyers aren't aware of is what is called a gift from a blood relative. For example, your parents may gift you some money for your down payment. Now, there are a couple extra steps to make sure that this is all done by the books, but it's a great option for so many people to get money for a down payment, even if they don't have it available right now. And by the way, this amount will have to be available at closing. So make sure you're communicating with your lender if you're waiting for that bonus check to come through as your down payment money. Lenders don't like surprises in your bank account. Outside of bringing your down payment to closing, you'll also have to pay the lender and the title company for doing their jobs to help you purchase the house. Now, the lender likely has to charge to do their job, but those fees can vary from provider to provider. And some institutions even offer no closing cost loans. Now, there's some fine print that shows you how they get paid, but you may not be the one directly paying for it. For example, my company, Keller Williams, also has a program called Keller Mortgage. Because it's all wrapped up into one company, Keller Mortgage doesn't charge borrowers to process the loan. The loan officers get paid by the company's overall profits. Now, there may even be money back at closing for certain loan amounts. Now, the lender has also been working with your insurance company to make sure that you're going to have homeowners insurance on the new home. Because this premium is paid once a year, the lender is going to collect 1 year's worth of that premium at closing. And then over the next 12 months of payments, a portion of each payment goes into an escrow account to pay the next year's worth of homeowners insurance. We commonly call these prepaids. Now, while they aren't really creative ways around paying them, this might be something your agent can negotiate the sellers to give you a credit toward. It's all part of that negotiation stuff, so talk to your agent about your options there. And same as your lender has been doing a job and has to pay its people for that work, so does the title company. The title company has been going through all the ownership files for the property to make sure that everything is in order and that you can take free and clear ownership of the property at closing. Now, each title company has slightly different fees, but these are usually based on the sales price, so call around and ask for an estimate. Your agent should also have a trusted title company to recommend, and they might even price match. And as with any professional service, I recommend using someone that you trust or your trusted professionals trust. So check rates, but ask your agent which title company they prefer to work with. Along with the fees for the title company employees to do their job, they are also responsible for collecting a prorated amount for the yearly taxes. The sellers are responsible for their ownership from January 1 of that year to closing day, and you as the new owner are responsible for the day after closing to December 31st. But don't worry, this amount goes into that escrow account I mentioned earlier. The lender is going to write a check at the end of the year for you, and then each payment you make for the next year sends a portion back to that escrow account, and so on. So don't panic that first December when you receive a statement for the year's worth of property taxes. If you look closely, it says, "Do not pay," but sometimes you have to look for it. Buying a home can be quite expensive, but there are lots of creative ways to minimize that cost. Have questions specifically about your upcoming purchase? I'd love to talk more. Send me a text, shoot me an email, or even send me some smoke signals, but let's get talking.